James Sim, you invest in European equities. Which stock market on a country basis surprised you the most this year?
Perhaps not so much this year, but certainly over the last 2 to 3 years, I think the country that's made the most progress has been Spain, actually. Obviously, people were very negative on it in 2012. But from my visits to Spain over the last 2 to 3 years, it's become apparent they've done a huge amount of structural reform, massively improved their economy. And actually, there's quite a few incredibly well-run companies with very strong management teams based in Madrid and Barcelona. And we've benefited from that within the fund over the last 5 years.
Could you give us an example of one of these companies?
Yeah, sure. So a good example would be something like Grupo Catalana Occidente, which is the Catalan insurance company. Obviously in the news a lot at the moment. 5 years ago, I met that business, and it's a family-run business. It's been going 160 years. It's perhaps not the sort of business people think of when they think of the Spanish market, very conservatively run. When I met them, the business itself was actually trading less than the excess capital in the market. So effectively, we were buying the shares for free. So that was a great investment opportunity. And it's in a very niche little market, which is very profitable, which is credit insurance. So that's a stock that over the last 5 years has probably doubled or possibly even tripled since we bought it. So that's been a great investment, actually.
Compared to the benchmark, you're underweight in Switzerland, but the market went pretty well this year. Didn't you miss something?
Yeah, so Catalana Occidente was one we got right. Of course, we get lots of things wrong, and being underweight Switzerland has been a headwind. For me, it's not so much about the country, actually. It's more about the bottom-up investment ideas. And when I go to Switzerland and I try and find some interesting investment opportunities, I'm afraid I come back looking at a lot of these stocks. Nestle would be a good example, and thinking actually they're really very expensive. And I think part of that, of course, has been the negative rates in Switzerland and the monetary policy that the Swiss government's followed, which has brought down the cost of capital. And you've got a lot of very well-run companies in Switzerland, but of course they look a little bit like bonds, some of them. So they get that halo effect from a lower cost of capital. So that's why I've been underweight Switzerland. We continue to think inflation's going to come back. So the fund is positioned to benefit from inflation coming back and interest rates going up. And that's what's led me away from Switzerland. But as you rightly point out, I'm afraid this year it's been a bit of a headwind for investors in my fund.
But did you own Swiss stocks? Which ones?
Yeah, so where we find value, we will take a position, of course. And as you mentioned, we're trying to be benefiting from inflation and higher rates. So that naturally leads us towards financials. So in Switzerland, the ones we've taken a position on are Zurich. They've got a new CEO in there, Mario Greco, Italian chap, perhaps a little bit more dynamic than the historic management team. Obviously, there's some very sad news that over the years with that management team. But Mario Greco's come in. He's sort of, I think, reinvigorating the business. And the key thing for me is it's still yielding 6%. And that dividend to me looks sustainable and possibly can even grow. The other one we've taken a position in is Swiss Re. For many years, 5 or 6 years, pricing in the reinsurance market has been under pressure. Part of this has been a function of these very low rates, so people have been looking for returns wherever they can get them. And so Swiss Re suffered there. With the recent hurricanes in America, we're hearing that pricing may be stabilizing and in fact may even be increasing. Again, it's a nice dividend yield stock. It's got plenty of capital. So Swiss Re, we think, is a good way of accessing that opportunity.
You just mentioned two financials. Do you own other financial companies? What's the investment case? Do you expect raising rates? What are other reasons for financials?
Yeah, so absolutely. Higher rates, higher inflation. Sometimes with stocks that are very cheap, you almost don't know what the catalyst is going to be. You just know 3 to 5 years into the future, you should have higher share prices. Where I invest in banks, for example, to use a small example of financials, where I invest in banks, we tend to choose the highest quality ones. They're not the very cheapest, but they're still relatively attractive. Now, and I also prefer simple banks, so retail banks rather than investment banks, which obviously leads us away from the likes of say, UBS. So that's led us into Central Europe, particularly consolidated markets like the Nordics or Belgium, where you can start to see, even if you don't have rate rises, increasing margins for these banks. Typically, they might trade on 12 times earnings, so it only takes me 10 to 12 years to get my money back. If you turn it the other way, I'm getting a yield of about 8%, an earnings yield, dividend yields 4%. So that would be the sort of thing I'd go for.
Your favorite bank?
Probably today my favorite bank would be Danske Bank. It's the Danish bank. We were hoping that we might see rate rises in Denmark. On a medium-term view, I think that's possibly true. They've got a very entrepreneurial strategy to grow. So they've entered Sweden and Norway via deals with the local unions there. And these deals are allowing them to offer cheaper mortgages to this subset of the market without disrupting the market. 4% dividend yield, 4% buyback, so 8% cash return to shareholders in a consolidated market, one of the cheaper banks in Europe. It's a stock I really like.
Do you have other stocks you judge as overlooked by the market at the moment?
Yeah, so what we tend to do is go to a Centre of European Finance once a month for 3 or 4 days. We might meet 10 or 15 companies. If I come back from one of these trips with one good investment idea, that's fantastic for me. Unfortunately, means 9 out of 10 go in the bin. But so long as the one we find is a good idea, then that can be a very powerful driver for share prices. So we're constantly looking for those, if you like, diamonds in the rough in Europe. The most recent success we've had is a small Welsh semiconductor company that's basically making the wafers that mean Apple can do the 3D sensing on the new iPhone. It's a brand new market. My bet is that in 3 years, 5 years' time, every phone will have 3D sensing on, and this small Welsh semiconductor company will be a much bigger Welsh semiconductor company.
We're looking forward to that. Thank you very much, James Sim.
Thank you, Everett.